Welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name's James Marlay, and today we're talking about the big banks. Most of you own a few. They're a huge part of the economy, and to help me talk about what went wrong and what went right in their earnings, I'm joined by Matthew Haupt from Wilson Asset Management and Scott Olsson from Firetrail. Well, let's get the lowdown in a sentence. Scott, your view on the bank reports, just one sentence. What's your summary?
Summary, I think, would be dividends are back, supported by pretty strong reported earnings, but I think the core earnings outlook is still a bit mixed.
Okay, that's a long sentence. Matt, if you give me just one sentence on bank reports, what have you got for me?
All right. Extremely encouraging with more to come.
Okay, let's talk about the more to come. What did you like in the results? That's a pretty positive summation. So what did you like?
Yeah, I think the real positive was around provisioning. All the models are saying release provisions and they're holding them back. So if the economy keeps improving on this trajectory, you're going to see a lot of provisions released, which will give them more tailwinds for the rest of this year.
Okay, it's been a long time since we've used the word tailwinds to describe the banking sector. Scott, do you agree? Do you think things are finally blowing in the favour of the Big Four?
Yeah, I mean, there's definitely a lot more going for the banks now than there was. I think overall our view, though, is that a lot of those tailwinds are factored into the prices now, and one area that's still a source of weakness is on those margins. They had a really good half, but I think the trend from here is downwards, which puts a bit of revenue pressure on the banks still. Okay.
We had a shake-up in 2020 with COVID. A lot of businesses had to look inwardly to try and survive and then thrive on the back on coming out of that disruption. Out of the Big Four, knowing what you know now from the reports, is there a bank that you think has done a particularly good job of reshaping itself on the back of the shake-up?
Sure. I mean, I think it's still in progress, but I think NAB is a business that is positioned really well from our point of view. Ross McEwen has made some good moves, bringing a lot of focus and accountability to the business, and I think the balance that they've got between controlling costs and driving revenue opportunities is just about right, and it's quite a differentiator across the banks at the moment.
Okay. Same question for you, Matt. You look back to how they were prior to the crash, and you look at how they came through it. Is the one that stands out as having fared better than the others?
Yeah, I think the clear winner is CBA based off trajectories. Like you look at their loan growth, you look at the way the business is generating capital, the returns, it's a clear winner. I agree with Scott, they like very much like NAB as well, but more of a work in progress, but the clear winner over that period for me was CBA.
Okay. There's not that much surprising that happens within the banks. They're big, they're boring, they've been around forever. Was there anything that, you speak with the executives, you look through the results, anything that caught your eye and made you sit up?
Yeah, on the negative side, the capital markets income was quite weak, and I thought with rates moving everywhere and FX, there'd be some more income on that side. On the positive side was really around deposit margin benefits from winding back deposits. So that really helped NIMs and shape some of the results we saw.
Okay. Anything that caught your eye? Anything that jumped off the page for you?
Yeah, it was that cost target from Westpac, that $8 billion number. That's down from a $10 billion base, so a 20% absolute reduction. You take into account inflation, it's something higher than that. The banks have shown it's very hard to pull out absolute costs. I think if they do it, it's admirable, but I think it's a big target to put out there.
So you're not quite sure that's a question mark next to that number?
That's a question mark for me. I think if they achieve it, the revenue outcome will be lower than the market's expecting. It's very hard to do that without revenue consequences.
Okay. Well, investors are about to get showered with close to $7 billion worth of fully franked dividends. Turn it back 12 months, that was on hold and investors were starving. So are we at the inflection point for dividends and have we got more in the cannon?
Yeah, well, it's definitely higher than I was thinking it was going to be 6 months ago. From here, I actually think it's going to be pretty flat. Obviously, you've had the benefit of provision write-backs in these results, which has helped. Going forward, those will moderate a little. You'll get a little bit of core earnings growth. So I think overall dividends stay around that level, which is still kind of 4.5% yield. It's pretty reasonable yield that they're back at now.
Relative, still quite attractive.
Yeah.
Matt, I'm going to stay with you on dividends. Pre-crisis, banks were paying out 70, 80%. Now the payout ratios have been dialed right back. You think there's more to come on the dividend front, or are you with Scott? We're kind of flattening out from here.
Yeah, I mean, it all depends on your trajectory of the economy. But I think, when you look at the capital position of the banks now, they are incredibly strong positions. So I think you're going to see special buybacks, like Commonwealth Bank have got a huge amount of capital. They're seeing a 12.7% with more capital coming in, you've got NAB who are going to do on-market buybacks. So the capital management is definitely a theme you're going to see over the next couple of years from the banks.
Okay. Now, the banks have been a bedrock of the Australian financial markets and the financial sector more broadly. They've proven themselves to have held up really, really well throughout 2020. But with this low interest rate environment, free money, we have seen a proliferation of new competitors coming into the market. I think more broadly, as we look at the sector, what sort of risks are you starting to see when you cast your eyes a little bit further outside? Is there anything that's catching your eye as being speculative and risky?
Yeah, I guess when you've got free money around and credit spreads compressed, you get all these, up and comers because the cost of capital is so low, availability is so high. For me, you're starting to see a few of the neobanks they call rollover already. Before we've even had an explosion of a credit cycle or cost of funding go up. So neobanks, it's an incredibly tough business banking, and it's not just about having distribution. It's about having balance sheets with access to capital. So for me, that is an area that is impending disaster.
Okay, Scott, you got some risks that you're seeing around the fringes that sort of make your eyebrows stand up?
Yeah, I mean, it's not so much a big blow up risk, but it's more risk to bank revenue lines outside of that net interest income line. Areas like FX fees and things like that, I think they've been ripe to kind of be disrupted for a while now, and I think you're just seeing smaller guys come in and do a good job there. Very hard to see how the banks continue to grow those fee lines because people, they just don't like to pay fees, and they'll find any way they can to get a better deal.
Okay, so you see the new competition being a risk for the banks rather than a risk to the sector?
Yeah, that's more just a risk to revenue profile and fees recovering. I think there will be a bit of recovery off the back of activity, but I wouldn't expect a big bounce because there are a lot of guys competing for that pie.
Well, some upbeat news for the banks. They've bounced back out of COVID. Dividends are coming your way, but just be cautious. After 20% in the calendar year to date, some of the good news might already be baked in.